Have you ever wondered how some people make so much money and even become millionaires by only investing in trades? Of course, it is not that easy, and it takes a lot of exploration to become successful in a trade. Technical analysis has become a powerful tool that has helped traders efficiently evaluate different stocks, providing valuable insights into market behavior. Utilizing the power of technical analysis, you can enhance your decision-making ability at a higher level. Welcome to Trading Talks, your ultimate destination for expert advice on all things finance, cryptocurrency, and investing. Today we're going to be talking about technical analysis. Let's talk first about what technical analysis is. As opposed to fundamental analysis, it is concerned with analyzing past price and volume action to predict future price and volume action. We may learn about market sentiment and anticipate price changes by looking at past data and utilizing indicators like moving averages and chart patterns. Opponents of technical analysis say it's useless because it doesn't take into account fundamentals, but prices and volumes reveal traders' motivations and attitudes. While it is not fail-safe, it can help traders become more knowledgeable and successful. This tool helps predict price, volume, and implied volatility by analyzing past trading activity. They generate short-term trading signals and improve valuation assessments. Charles Dow introduced the Dow theory in the late 1800s, and since then, researchers like Hamilton, Rhea, Gould, and McGee have contributed to its development. This now includes hundreds of patterns and signals. You should learn practical approaches of applying technical analysis while doing business. It can be applied to various securities with historical trading data. Everything from stocks and futures to commodities and currencies is fair game. Surprisingly, it is most common in the commodities and foreign exchange markets, where traders tend to focus on short-term price fluctuations. It seeks to predict the movement in price of any tradable instrument based on supply and demand. It's not confined to the stock market alone. Besides stocks and futures, bonds and currency pairs are also included. The study of supply and demand as reflected in market price movements is one definition of technical analysis. Although most analysts focus on price movements, others delve deeper. Statistics like trade volume and open interest are also monitored. The key is to learn as much as you can so that you can make educated choices. This is not all. There is so much more to learn about it. So watch the video till the end and let me remind you to hit that subscribe button and turn on notifications so you never miss out on the exciting videos we share. Let's now speak about the many different signals and patterns that can be used in conjunction with technical analysis. It's incredible that scientists and engineers have developed hundreds of them. These indications and patterns serve as trading weapons. Not only that, to further aid in price prediction and trade execution, technical analysts have developed a wide range of trading methods. The market becomes much more manageable with this guide. Let's take a look at some of the most popular indicators in technical analysis right now. We have indicators that zero in on the present market trend. They aid in the identification of key market features, such as support and resistance levels. These metrics help us figure out if the price will rise or fall. Then there are indications that can tell you how likely a trend is to persist and how strong it currently is. It's like having a dial to determine how strong the trend actually is. It helps us determine if we can trust the trend or if it's starting to lose momentum, both of which are crucial pieces of information. It is also important to know underlying assumptions of technical analysis. Fundamental analysis involves a deep dive into a company's financial accounts to understand its value, and it assumes that a security's price already reflects all relevant information and focuses on analyzing price fluctuations statistically. Instead of examining the underlying factors affecting price, technical analysis looks for patterns and trends in price charts to understand market sentiment. Charles Dow laid the groundwork for it with two key assumptions. Markets are efficient, and all relevant information is already factored into a security's price. There are consistent patterns and trends in seemingly random price fluctuations. Professional analysts generally accept three assumptions in it. All important information is already reflected in the stock price, price moves in trends, and history tends to repeat itself due to market psychology driven by emotions like fear and excitement. These emotions and trends can be analyzed using chart patterns. You should have clear idea on the strength of technical analysis. One of its key strengths is its universal applicability. It can be applied to a wide range of financial instruments, including stocks, futures, commodities, and forex. Whether you're trading individual stocks, currency pairs, or commodities like gold or oil, this provides a framework to analyze price patterns and make informed decisions. You should direct your focus on price action to get another significant advantage. By analyzing historical price patterns, it allows traders to filter out market noise and concentrate on the most relevant information. This approach helps identify trends, support and resistance levels, and other patterns that may influence price movements. Supply and demand dynamics play a crucial role in it. If you consider these factors, analysts gain insights into market sentiment and price trends. You can understand the interplay between buyers and sellers by identifying areas of increased buying or selling pressure. This knowledge helps traders gauge the potential direction of price movements and make informed trading decisions. Support and resistance levels are key reference points in technical analysis. Support represents a price level where buying interest is strong enough to prevent further downward movement, while resistance indicates a level where selling pressure halts upward price progress. These levels act as psychological barriers and provide valuable insights into potential trend reversals. Traders use them to determine entry and exit points, helping optimize trade timing and manage risk. At this point, you might think technical analysis has no flaws, but the truth is it has some limitations too. Let's discuss some interesting limitations about this. Critics argue that historical price and volume data don't provide actionable information, and the efficient markets hypothesis supports this idea. They also claim that studying price patterns is questionable because history doesn't repeat itself exactly, and prices seem to follow a random path. Another criticism suggests that it can be a self-fulfilling prophecy, where a large group of traders using the same signals can cause predicted price movements. However, it's important to approach it with caution and not rely solely on it for long-term predictions. While there are critics, many traders still find value in studying price patterns and using technical indicators. Weakness of technical analysis. The assumption that past market patterns may reliably anticipate future price movements is a common knock against it. But the market is a living, breathing thing, and it doesn't always behave in the manner we anticipate. The past is not always a trustworthy predictor of the future, and neither are patterns of pricing. It's like making weather forecasts based entirely on historical data. You might be correct sometimes, but it's not a sure thing. This also has the flaw of ignoring the fundamentals that can affect a security's price. It gives no consideration to the financial health of a company, industry trends, or economic variables, instead concentrating entirely on pricing and volume data. Imagine judging a car's merits based on how it looks alone, without taking into account its performance or safety features. You may not get the whole picture from it. Others have pointed out that it might be open to criticism for bias. Inconsistencies in forecasts might arise when various analysts draw different conclusions from the same chart patterns. It's like taking a Rorschach exam, where each person will interpret the ink blots differently. The subjective nature of the data might complicate trading decisions based solely on it. Technical analysis has the potential to create its own reality. Many traders acting in accordance with the same signals and indications might have an impact on the market and set off a feedback loop. It's like a stampede that occurs when everyone tries to leave through the same door. This strategy could prove effective in the short term, but its durability is questionable. And there you have it, a comprehensive guide introducing you to the fascinating world of understanding technical analysis. As a trader, you now have a valuable foundation to embark on your trading journey with confidence. Thanks for watching, and be sure to subscribe to our channel for more expert advice on finance, cryptocurrency, and investing.